So moving on then to the types of charitable strategies that we want to talk about, you can see along the bottom here that we're going to be explaining these along the axis of purely altruistic to purely self-interested. Now, we're talking about this in a tax seminar. None of this is purely altruistic. Just to be very candid, you're here to talk about how to reduce your taxes. If you're giving money to a donor-advised fund or a foundation, it's not purely altruistic. You get a deduction, and we'll talk about that. But those are definitely on the more altruistic side of things for reasons that I'll explain, whereas charitable trusts are more on the self-interested side of things. So, starting on the left, donor-advised funds and foundations. The idea here is very straightforward. You can get $1 of deduction for every dollar that you put into a charity. You can give to a nonprofit, you can give to a donor-advised fund, you can give it to a private foundation that you've set up and run. In all cases, you can get an immediate 100% tax deduction, subject, of course, to those limits that Farhan talked about as to how much of your adjusted gross income you can write off. The value of doing this via a donor-advised fund or a foundation, as opposed to giving straight to charity, is that you can give this year, potentially bunching those donations and increasing your deduction, and you can spread out the donations. So if you put $100,000 into a donor-advised fund or a foundation this year, you get a $100,000 deduction, but the money stays in that account and you can invest it, you can grow it, and you can give it out to charity over time. And that can be valuable if you want that big deduction this year, but you're not ready to commit the money to a particular charity, or certainly all of the money right up front. Now, the downside of this approach, and the reason that it sits on the altruistic side of things, is that you're giving the money away. People talk all the time about donor-advised funds and foundations and charitable giving as a tax strategy. And our view is that, sure, it is. You're getting a deduction, but it's really only for folks who are charitably inclined anyway, because you're not seeing that money again. You're giving the money away and you're taking a deduction and it's going to charity eventually. With a foundation, you can pay yourself or pay your family members to run it. With a donor-advised fund, there are certain ways to get some of the money back. But for the most part, it's staying in there. And that's why we view these as mostly charitable strategies, whereas the next two are much more on the self-interested side of things, because in both of the next cases, CLAT and CRUT, you get to keep a substantial amount of the funds that are going into the trust while also getting charitable benefits.
I also would love to connect DAFs to our next slide on the oil and gas and making a comparison, because I've gotten this question and I think it's a good thing that you called out that you lost that dollar on the day. I mean, if you're doing it for philosophical reasons, that all makes sense. But if you're thinking it's a tax mitigation play, then there may be better things out there with the same risk profile they can execute on. But we can talk about this. In terms of charitable lead annuity trust, to reduce your taxes on ordinary income. The distinction here is charitable remainder trust is our top product that I could say at this point of time in the year. And we've been saying the charitable remainder trust only solves for capital gains. It doesn't solve for ordinary income. So the distinction here is charitable lead annuity trust that you're looking at solves for ordinary income. And charitable remainder unit trust solves particularly for unrealized capital gains. So we just want to make sure we call that out. In terms of charitable lead annuity trust, if you give $1, if you put $1 into a charitable lead annuity trust in a CLAT, like a donor advised fund, you get $1 worth of deduction. Same limitation of AGI applies, 30%, 50% of your AGI. But if you put $1 in, you get to take $1 worth of deduction in year one. Simple as that. The upside here is compared to DAF is that you get to grow the money inside the trust. There is a certain amount that goes to charity every year over the length of the trust. But whatever is left at the end of it, the remainder in the trust, you get to keep it tax-free. So if you set up a trust, if you put $1 million inside a CLAT and you set it up for 20 years, a certain amount is going to go to charity every year. And at the end of, if there is $100, $200, $500,000 left at the end of the trust after 20 years, you get to keep it tax-free. And that's where the value proposition lies. So I'm just going to quickly go through charitable remainder trust.
I agree we should speed, but let me just do 30 seconds on the mechanism of a CLAT, because this is something that actually is quite powerful. I want to say a CLAT, we've of course run the numbers. We do a lot of our work quantitatively, as you all know. CLATs are going to be a good fit. Certainly, they're going to be better than a donor advised fund because you get to keep some of the money. And in addition, they're going to be an especially valuable tool if you're planning to give money to charity anyway. someone, whether it was Ash or otherwise, asked if they can get a recording. And the answer is yes. If you're here and registered, you're going to get a recording afterwards. So don't worry about that. The way a CLAT works is that let's say you put $100,000 into the CLAT. You get the deduction today as though you had donated that money to charity, but you don't have to give it to charity right away. Instead, you get to invest that $100,000, have it grow over time, and give the money to charity over time, so that by the end of the term, you've given the $100,000 plus interest to charity. Let's say the interest rate is 4% and it's growing, $100,000, 4% a year. You're going to end up having to donate probably about $200,000 over 20 years. If your investments return 10% and as a result are worth $400,000 at the end of 20 years, you've given 200 to charity, but you get to keep 200. And in that way, very obviously, if your goal is tax planning as opposed to charitable giving, you're doing way better with a CLAT than you would be if you just do a donor advised fund or foundation. So that's a very important distinction, and why we always say, if you're looking at a DAF, you should absolutely be considering a CLAT.
CLAT.
So Farhan, do you want to just very quick touch on CRUTs?
Yeah, I'll quickly go over it. So charitable remainder trust specifically solves for unrealized gains, and it's best suited to sell if you have a highly appreciated asset. And a highly appreciated asset can be a rental property that has appreciated a lot in value. It can be crypto. It can be a public company stock that you own, that you bought. It can be a business that you're selling, and we have seen that a lot as well. So it can be anything that has highly appreciated, doesn't have a debt on it. That's very important because a trust cannot own something that has a debt on it. In real estate, particularly, some properties have mortgage on it. So I want to make sure that's cleared, but that's a constraint here. So you put an asset inside the trust, you get a charitable tax deductions. If you put $1 million in, you get 10% in tax deduction. You get to sell the asset inside the trust tax-free, no taxes because trust is tax exempt. Then you get to reinvest that money as well inside the trust. You can do almost anything. There are few constraints, but almost anything. You can invest in stocks, bonds, ETFs, private investment, bunch of stuff. And then you get to take money out of it every year that you pay taxes on. So the value proposition lies in, and it's a slightly complex product, and we'll be happy to get on a call with you to explain this. But the higher level value prop is that if you put $1 million in, and if you live in California, you're going to pay around $650,000 just in long term. You're going to pay $350,000 in long term capital gains, and you'll be left with $650 to do whatever you want to do with it. In a trust, in a charitable remainder trust, if you put that inside the trust, you get $100,000 worth of deduction in year one. You get to reinvest the full $1 million. So you have a $350,000 worth of a head start. And that's why the money grows faster inside the trust. And suppose if you're getting, I don't know, $50,000 and 55% in distribution percentage, or even 10%, $100,000 in distribution, you're paying taxes on that $100,000. You're not going to have the same marginal tax rate as you would have been selling at $1 million. That's tax law harvesting. And, looking at these numbers and everything, you can get a 3 to 4x return. There are some variables here, and we have a calculator where you could play around with the numbers to see the ROI in your situation. But the important piece here is that we have seen people getting 3, 4x return in comparison to if they would have just sold the taxes and paid the taxes on that and invested the money. And one thing I know, Jeff, you're gonna add something just to clarify, everyone.
Yeah.
Charitable lead annuity trust is something that you can execute within the time that you have left. Charitable remainder trust is also something that you can execute with the time that you have left with the valor, specifically, I want to say. And that's why we have been able to execute these things in a very efficient manner, rather than you going to an attorney. He's asking for 2 months from now, what's going to happen and everything. So if you're thinking you have a highly appreciated asset, you want to take the deduction, there's still time to do this.
And just to that point, very excitingly, right now, we're getting you your trust within 24 hours. Within the next couple of weeks, we're going to be moving to 1 hour trust generation. Answering a few questions that have been asked here. Sandeep asked, if you do a CLAT in December, what rate do you use for the interest? And the answer is you can look back up to 3 months. And so you'd use the November rate, which is 4.4, which is the lowest rate that's available. So that's a good question and valuable. Farhan, you answered this. The deduction with a CRUT is typically 10%. You can get more. It's nuanced. And so I'd suggest that if you're really interested in pursuing this, set up a call for as soon as possible and we can discuss it. Mike or someone asks, can you start the payout upon an event in the future? The answer is yes. You can do what's called a flip CRUT, which triggers standard payouts starting when you sell an asset or when you reach a certain age. Are all these strategies still valid? Farhan touched on this. All of the ones on this slide are still valid for this year, still available, and we can get them done. Some of the ones that we're going to be talking about on the next slide are, and some are not, and we'll be very clear about that. We are crunched for time, so I'm going to strongly suggest that you check out learn.valor.com, where you can find our guide to CRUTs. And I promise in 1,000 words, you'll get it. But if you have further questions, we're here by email. You can always chat with us on the site, and we're happy to explain.